Steve here. All right, the bell's rung on Thursday, and let me tell you, this market is sitting on a knife's edge. Now, you might look at the S&P, see that small dip, and think it was just another quiet day. But you'd be dead wrong. Let's get into what's really going on under the hood.
That's really the only way you can describe today. You've got these headlines about ceasefires trying to throw a jab, but the reality on the water is throwing haymakers. It's creating an incredibly dangerous environment, and if you're not watching the right signals, you are absolutely going to get knocked out.
So let's look at the tape. The S&P 500 slipped less than 0.5%. On the surface, it looks like a controlled breather, right? But then you look over at Brent crude, ripping over 2.5%, shattering that $100 level. That, my friends, is the monster in the room tonight. It's telling you the real story, while capital is rotating out of stuff like gold and Bitcoin to get in on that inflation trade.
Okay, now for the interesting part. This is where we look beneath the surface. I want you to forget the headlines for a second, because the charts are flashing a major warning sign. They're telling us this market is just running on fumes.
The tool we're going to use here is the Commodity Channel Index. You'll hear it called the CCI. Look, all it really does is measure how far the current price is strayed from its average. When it gets stretched way too high or way too low, it's basically telling you that a snapback is coming. Think of it like a momentum gauge.
And right now, the 20-period CCI is printing a reading up around plus 145. So why does that matter? Well, this is a classic, textbook statistical exhaustion signal. It means the market's momentum, its energy, is stretched to the absolute limit. That rubber band is pulled back as far as it can go.
And this chart right here just lays it all out for you. You can see the S&P pulling back from its all-time high, while that CCI indicator down at the bottom is just pinned to the ceiling. This is what a stretched rubber band looks like on a chart. Now, I want you to keep your eyes on two key levels of support below us. You've got the 50-day EMA at 6,781, and then the big one, the 200-day simple moving average. That's your long-term floor, way down at 6,696. Here it is. Here's your trigger. It is simple and it is clean. If that CCI reading crosses back below that 100 line, that is your signal. That tells you the momentum trade is done. It's over. It's a flashing red light that a mean reversion move, a sharp pullback toward that 50-day moving average, is now officially in play.
All right, let's connect this technical picture to the real world. Because let me tell you, all that economic data you're hearing about, PMIs, jobless claims, forget about it. Right now, it's all just noise. The primary driver for every single tick in this market is happening in one place, the Strait of Hormuz. And this is why oil is the only chart that matters tonight. That huge rip to over $103 a barrel, that's not about supply and demand fundamentals from some report. No, that's about geopolitical reality. Despite all the talk of a ceasefire, the situation out there turned kinetic again. Iran is restricting traffic, and a U.S. naval blockade is tightening its grip.
And look, we are on a clock here. A hard deadline is approaching. Events on the water have already gotten hot again. The U.S. blockade is tightening, and the clock is ticking toward this Sunday, April 26th. Why Sunday? Because that's when Iran's main storage facility is projected to be completely full. If there's no deal, they're going to be forced to shut in their wells. And that is a supply shock that this market is absolutely not ready for.
Which leads us right to this. The equity market, bless its heart, is trading on the hope of a peace deal, a deal that is being violated in real time as we speak. It is completely ignoring the massive risk staring it in the face this Sunday, and that is a dangerous level of complacency.
So what you have now is a truly binary event. The market is at a fork in the road, and the two paths lead to completely opposite destinations. When this tension finally breaks, and it will, the move is going to be violent. There is no middle ground here.
And these are the two warring scenarios. You've got the bulls betting that all this pressure forces Iran to completely fold by Friday. If that happens, you get a peace dividend rally, and the algos take us screaming towards 7,200. But then you have the bears. They see a Hormuz crash coming. They're betting on no deal by Sunday, which would trigger a violent sell-off right back down to that 50-day EMA support near 6,781.
So the big question is, how do you trade this mess? Well, right now, it is not about trying to make a fortune. It's about making damn sure you don't lose one. Capital preservation is the name of the game. It's the only trade that matters when warships are on the move.
So here's your plan. It's disciplined, it's simple. 3 steps. Step 1, respect your support.
That 50-day EMA at 6781 is your line in the sand. If a no-deal headline breaks it, you get out of the way, period. Step 2, watch that CCI. If it crosses back under 100, you know the momentum crowd is heading for the exits. And finally, step 3, keep one eye glued to oil. As long as Brent is trading above $100, risk is high and the inflation trade is in control.
And that brings us to the final thought, the only rule that matters in a market like this. Small sizes, tight stops. Whatever you decide to do, keep it small and know exactly where you're getting out. Don't trust the headlines until you see the tankers moving freely with your own eyes. In a market this tense, discipline is your only defense. Stay sharp out there. The ledger is closed.